what we see people use most often are previous employer retirement accounts. So you've had a 401k, I changed jobs. Those funds are always going to be able to be moved so that you can roll those over. If you have an existing rollover IRA or IRA somewhere else, yeah, you can transfer over a portion of that Fidelity account, all of it, however much you want to move over, and we'll just act as a separate custodian for these types of investments. In my day-to-day talking to people, the biggest thing is not realizing that these assets can be deployed into investments like this. They think they have to invest out of their bank account or their other investable ones, not realizing some of their largest investable assets are in these retirement accounts from old pensions, old 401ks, and those can actually be rediverted or diversified from the stock market into funds like this and get a better return in those accounts. And then, like I said, the tax advantages, the compounding growth absent taxation is a huge wealth building tool.
Right.
So that's where these can basically grow those account values exponentially.
Hello, and welcome to Fireside with a VC. My name is Andrew Romans, and today we're with Matt Calhoun talking about self-directed IRAs and how you can use these to invest into startups as well as venture capital funds. Matt is a director at Equity Trust Institutional Services, whom we've been working with for years, going back to when they were Midland Trust. And I guess they went through a merger and that went through, recently. And so these companies are getting bigger and bigger. But Matt is an expert on this stuff. And we're basically going to talk about how you can create a self-directed IRA and use that for investing in private markets, either directly into a startup or via a VC fund. So Matt, great to see you. Thanks for making some time.
Thanks, Andrew. I really appreciate you having me.
So Matt, maybe explain what is a self-directed IRA? How is that different from any other retirement account? How does this work?
Yeah, no, I actually get that question a lot. One of the most common questions. It's always funny to answer it when I tell people there actually is no difference. They're both created in 1974. So it's just a retirement account. The key difference is certain custodians will allow you to invest in things and some don't. Schwab, if you have an account there, they really like you to invest in stocks, bonds, mutual funds, and people think that's all you can invest in. But actually, when IRAs were created, you were able to invest in startup companies, real estate, venture capital funds, different asset classes that the IRS allowed you to do. But these large institutions just kind of funneled everybody into the stocks, bonds, and mutual funds that they sold that are available on the public market. Certain custodians like Equity Trust and some others have allowed you to invest in what they call and we call alternative investments. So like, as you mentioned, startup companies, different asset classes that people may feel more comfortable in or can chase better returns. Those custodians allow you to invest in that with those tax advantage retirement dollars.
Okay. I mean, it's funny going through the journey of starting VC funds and raising LP capital.
Yeah.
One obvious thing is that we invest in startups and these guys become billionaires or worth hundreds of millions of dollars.
Yeah.
So we're getting chased by every Goldman Sachs, Morgan Stanley, JP Morgan wealth manager that wants to take me to a Michelin star restaurant and get introduced to our CEOs that they can manage 40 million minimum, whatever their kind of target sizes as a stockbroker for the super rich. And then I say, well, why don't you guys put our fund on your platform and bring some LP capital into our VC fund? We're doing better than 90% of other VCs. And unfortunately, they really can't, because like if you're a wealth manager for the bulge bracket, firm like UBS, you can only get paid on what is on platform and kind of promoted. And so they kind of have their own fund of funds. I mean, you could even argue it's a bit like the politician only gives a permit to build a shopping mall in the bird sanctuary to the guy that donated money to his campaign. So it's almost like one of those. But I guess with a lot of custodians, you're limited on the ability to invest into, and even with each IRA we've ever worked with, we've got to go through some paperwork to get on your platform. Like there is a process.
No, I was gonna say the self-directed part comes in because people tend to direct their own investments. So where you mentioned Morgan Stanley, a lot of them are fiduciaries. They have a fiduciary right to either sell what there's available on platform. With Equity Trust, we don't actually have investments that we advertise or put out or anything else. So the self-directed point is that the investors have the ability to pick where they want to invest in. As we have you fill out that form, that's because an LP has interest in investing with you. So we have you fill out that form. We just basically get some general information and then allow those people to direct those retirement dollars to a fund like 7BC.
Okay, so if somebody has, I don't know, even like matching 401k plan with Fidelity or something like
Hmm.
that, that their employer's been matching for the last many years,
Hmm.
they can they can get in touch with you, move some money out of a retirement account over to you guys. You become the custodian. And
Hmm.
then since, 7BC or other venture capital firms are on the platform, they
Yeah.
can invest out of that.
Yep, correct. Yeah, we'll never have a person on our team tell you, hey, you should really invest with this group. You get to pick your own investments. But yeah, you had a key point. So what we see people use most often are previous employer retirement accounts. So you've had a 401k, I changed jobs. Those funds are always going to be able to be moved, so you can roll those over. If you have an existing rollover IRA or IRA somewhere else, yeah, you can transfer over a portion of that Fidelity account, all of it, however much you want to move over, and we'll just act as a separate custodian for these types of investments.
Okay. And anything to understand on fees and timing for all the stuff to go down?
Yeah, so every custodian's gonna be a little bit different on the fee side. So call around, kind of see what's best. We have multiple options on fees, so we try to hone in what works best, whether that's just a simple AUM model. Most people really like our flat fee option. So we're talking about $300 a year roughly for across the industry, whether you're investing 25 to $1 million. Like it's a flat fee, so it tends to be the most advantageous for people. As far as timing, I tell people 7 to 10 days really to get your investment done. It can be done pretty quickly, but with paperwork, exchanging with other custodians, funds, normally will get your investment done within 7 to 10 days.
And what are the rules again for people that, some people just get caught up in life and haven't been planning well and doing a lot of
Yeah.
retirement. When you put money into an IRA, a lot of people are pretty entrepreneurial here or setting up
Hmm.
programs at startups. What are the rules? How old do you have to be before you can withdraw with a penalty? What does it look like if you draw it?
Sure. So currently the retirement age where you avoid that penalty. So there's a 10% penalty if you withdraw funds from that retirement account before 59 and a half. After 59 and a half, the penalty goes away. Now, depending on the tax status of those accounts, there may be some taxes. With a Roth IRA, we're talking about tax-free withdrawals. As far as contribution limits, that's going to vary, and everyone is eligible for different accounts. Currently, I think this year, if you're just starting a brand new traditional Roth IRA, it's like 7,000 a year. But if you've had, SEP IRAs, solo 401ks for self-employed individuals, or your 401k for an employer, there's going to be much higher, like 10 times that contribution limit. And then there's other pension plans that are done. So depending on what you qualify for, contribution limits can vary widely.
I always think this kind of stuff pairs well with, I mean, so we've been working with you guys for years, and we have some other self-directed IRAs where people basically just
Hmm.
invest through their IRAs into the fund.
Yeah.
This is usually on the, accredited smaller side than the bigger family offices.
Hmm.
Um, but they don't want to withdraw before 59 and a half.
Sure.
And so almost everything we invest in is QSBS 1202 qualifying. So if we
Mhm.
hold the stock for 5 years and a day, there's basically zero tax. It's actually zero tax on the greater of the first 10 million of gain, or 10x what our cost was, what we paid
Mhm.
to invest. So if we put a $10 million check into something and make a gazillion dollars, 10x the 10 million is 100 million. So you pay zero tax on the first 100 million that flows through as an S corp to our LPs. And so when we're distributing that money back, so just to talk this through, when somebody invests through a self-directed IRA to a fund, we
Mhm.
invest in a bunch of companies. We start to divest either secondaries, IPO, or M&A.
Mhm.
And when we make a distribution back to you as the custodian, they can just reinvest that in anything, right? It doesn't really matter.
Correct. Yeah. Tax deferred, you still get all the tax shelters of the retirement account, and you can redeploy that how you wish. And it's really complementary because most people think of their retirement accounts as their long-term investing bucket. So it marries really well with that, like you said, 5-year, 10 line, and some people might have a 10-year or 15-year timeline. So these tax advantages really complement each other.
All right, cool. Well, listen, is there anything else we should know? Why to use this? I mean, I think we covered the bases.
Yeah, it's really everything. Like I said, in my day-to-day talking to people, the biggest thing is not realizing that these assets can be deployed into investments like this. They think they have to invest out of their bank account or their other investable ones, not realizing some of their largest investable assets are in these retirement accounts from old pensions, old 401ks, and those can actually be rediverted or diversified from the stock market into funds like this and get a better return in those accounts. And then, like I said, the tax advantages, the compounding growth absent taxation is a huge wealth building tool.
Right.
So that's where these can basically grow those account values exponentially.
The other thing, I kind of said it, but I'll be more blunt with it, is that
Yeah.
the person giving advice to a lot of your clients
Mhm.
is getting paid as a wealth manager, a
Yeah.
percentage of your total AUM.
Correct.
And if you move money from like Amazon stock into Microsoft stock, they continue to get paid like 2% a year. And
Mhm.
that pays for their kids' braces and their ski trip and the,
Sure.
the cost of living in this world.
Yeah.
If they invest into a fund that's not on platform, they lose the income. So they were
Correct.
getting paid on you. Now
Mhm.
they're not. So the person giving advice
Yeah.
is often advising you to go somewhere, invest in something where they're making money. It's like that's just an issue that is real in this world. So I think it's
Yeah.
interesting for people to have a little account that's free of that, and they don't have some incentive saying invest in that because I don't get paid if you invest in this.
100% correct. As a typical, it's an industry issue that people are only compensated based on what they can provide and not what's best for the client. And I tell people on the phone all the time, like, expect your financial advisor not to be maybe happy about this. But if
Yeah.
this is something you're passionate about and you think it's best for you, or somebody is advising you to do it, we have a route to get you there.
Well, awesome. All right, cool. And what's the best way? I'll put your email in the show notes, but what's a great way for people to contact you?
Yeah, I'll give you my direct phone number that I put in the show notes, but emails, I'm always available on email. So
Okay. Okay. We'll put it right there. Okay, Matt. Listen, thanks for making time and hope to see you
thanks,
soon.
Andrew. Yeah.
Okay. Bye for now.